was struggling with what does 2014 mean in the context of 2015. And in 2014, we saw an unprecedented number of IPO and M&A exits. We saw more venture capital flowing into young companies than any time since the bubble burst. And we've seen the emergence of this new class of mythical beasts called unicorns. That is companies, private companies valued at $1 billion or greater. And we've seen about 80 of them. So what does this mean for 2015? And the panel focused on 2 or 3 trends, both of which have positives and negatives. On the unicorn side of things, what does it mean? We focused a lot about high valuations, and that suggests that there is a fierce competition for great companies. It also suggests if the economy were to slow down, we would see the same crisis we saw in 2000 when there was a massive series of recapitalizations, the reissuing of stock options because employees had pegged their options at valuations that were no longer even remotely realistic. Lots of recaps that hurt both investors and companies. So the good news is high valuations can create lots of value if the economy holds up, but they create a very, very high bar. We also discussed ways of thinking about valuation. One of the guidelines I suggested is, do you think you'll be able to accomplish the metrics and milestones that this round of financing and its high valuation is designed to achieve? If you have any doubts, maybe you ought to peg a lower valuation to protect yourself and your investors. Another trend we talked about was the rise, the reflourishing of corporate venture capital. When there are now thousands of companies with venture capital funds, 200 venture labs in Silicon Valley. The last time this happened was in 2000, and when the bubble burst, many of these investors disappeared. But right now the corporate world is strong, so we spent much of our time talking on partnering strategies. As one of the panelists said, Series C is often stands for your corporate round, but corporations are investing earlier, and they can provide capital, expertise, they can provide access to early customers, they can provide product feedback. So those are great things. On the negative side, they also can lock you up, prohibit you from dealing with their competitors, and spend a fair amount of time drilling into their technology issues that may have nothing to do with your technology issues. So again, the question is be careful. Overall, the panel thought that 2015 looks like a good year, but there is some expectation with the rise of interest rates that's going to happen globally that some of the frothiness, the bubbliness we're seeing will begin to dissipate and will begin to return to more of a normal valuation world, where valuations will still be strong but not excessive, unless there's an economic shock or a war, in which case we could see a sudden deflation like we did in 2000. But overall, the panel was optimistic, and the health of Silicon Valley as a venture and angel ecosystem has rarely been stronger. 2014 was a great year, and we all assume 2015 is at least going to be a very good year. My own thoughts about 2014 was that we have spent the last couple of years, and I think 2014 was a capstone year, where things are beginning to come together and make sense. Every time there's a technology transition, it takes a while for the world to get sorted. And 2014 sorted itself out in 2 important ways. One way, we've had all of these new kinds of investors. We've had seed funds, incubators, super angels. We now have a hierarchy that's emerging of funding, where you've got individual mentors, best friends who can help you build your company and find some capital, accelerators and incubators for young CEOs who need to understand how to build a company who've never done it before, institutionalized angel groups like my group, which can provide you your first $500,000 or $1 million, or in syndication larger, and then younger VCs, mid-stage VCs, and private equity. And that's now becoming clear again where we all fit into the ecosystem. Second thing, which I think is extremely exciting, again, where 2014 crosses into 2015, we've seen 3 major trends in the past several years. cloud computing, big data and analytics, and the Internet of Things. And what we've done in the past 4 or 5 years, and 2014 was a very active year here, was building out infrastructure, the tools, the basic toolkits, tool sets needed to make those markets work. We have now strong tools across cloud, IoT, and analytics. So we're no longer wondering who the cloud winners in those markets are going to be. Now the job is to put those pickaxes, spades, and shovels to work, building the next generation of great applications. Where I am looking as an investor is where those markets begin to converge. So where we can take big data about disease, combine it with sensor data about my body and my family, and data in the cloud about broad exposure to illness, and design personalized healthcare and personalized insurance products designed specifically for me. We're seeing a revolution in the energy industry with the digital oil field, where they're taking sensor data, storing massive amounts of data in the cloud, and being able to really expand the capacity and the ability of what's called tertiary oil recovery, of being able to recover oil from hard to mine deposits based on all of this big data. So with industry after industry, we're seeing, particularly industries that have not yet been digitized as nearly as has, for example, classic IT or financial services, we're seeing a revolution in those technologies. We've already seen it in media, where digital convergence has happened big time, and now with the cloud and massive numbers of small devices, we're seeing a revolution in how content is delivered, how content is shared, and how content is bought and sold. So we're seeing revolution after revolution as devices, big data, and the cloud increasingly merge. 2015, I think it's going to be a broad-based shift from investing in infrastructure to investing in increasingly vertical business applications. I also think that as interest rates rise and as cost of capital becomes a bit more expensive, we're going to see less frivolous investing and more focused on fundamental problems that are worth solving. That is, fewer apps to find a place to have a beer after work, and more apps designed to help you deal with chronic illness or managing your finances, or improving the quality of life in your neighborhood. I think those are much more fundamental problems than finding beer after work. Cheap capital means that there are lots of apps, accelerators, and incubators. I think we're going to see not an elimination of that, because it's a good thing, but a slowing down and a shifting of priorities.